The majority of economists and analysts were expecting a recession in 2023. They said it was inevitable, market's going to crash. Well, it didn't happen. So what they're now saying is that it's because it's been delayed, that the effect of the interest rate hike will whack the economy in 2024. So could this happen? Could we have a recession in 2024? And as investors, how can we prepare for this recession? So once again, the majority of economists and analysts are predicting a recession will hit the US market and economy by the end of this year or by next year. And of course, the media is playing this up. In just the last few days, we've got all these headlines. A recession is in America by 2024 looks very likely. And then on Bloomberg, it says stocks flash recession warning as cyclical stocks go down, trouble spreads to industrials. All right. And again, this is a list of the banks and their predictions. And as of now, again, the majority of economists and banks are predicting a recession in the next 12 months. There are a minority like Bank of America, Goldman Sachs, JP Morgan that are predicting no recession. So again, majority recession, minority no recession. So who's going to be right? So the first thing to understand is if you go back to history, you have to know that economists are very, very bad at forecasting recessions. And it's not their fault. It's because there are just too many moving parts that cause a recession or that avoid a recession. It's kind of like the weather service. The weather service, it's very difficult for them to predict the weather because, again, there are just too many unknowns and uncertainties that are changing all the time. So I'm not saying that we can predict any better than them. We can't. So if these smartest economists in the world can't predict a recession, what chance do we have who are not economists, right? In fact, a research study found that from 1992 to 2014, over the last 23 years, out of 153 recessions that occurred in 63 countries, guess what? Only 5 were predicted by a consensus of economists in April of the preceding year. So in other words, when most economists don't expect a recession, it happens. And when most economists expect a recession, it doesn't happen. It's kind of like when you look at the future, it changes the future. If everyone expects a recession, they tend to take measures to avoid a recession. It's like if you know you'll be hit by a car tomorrow at this road, you will not go to that road and not get hit by a car. But recession tends to hit when we least expect it. It's like you get hit by a car when you don't expect getting hit by a car, right? That's the whole point. So what can we do as individuals? So again, it's really hard to predict recessions, but there are certain leading indicators where historically it has found to have a higher probability of anticipating recessions. And of course, all of you have heard about this famous yield curve inversion. So in fact, that's one reason people are saying that the yield curve is so inverted right now that there has to be a recession. Because historically, every time you get a yield curve inversion, a recession occurred. Again, it's not 100%, but oftentimes it is. So let's take a look at the yield curve. Now, there are some people who compare the 2-year Treasury yield with the 10-year Treasury yield. But the inventor of this yield curve inversion predicting recessions, Harvey Campbell, he himself said you should actually use the 3-month Treasury yield versus the 10-year because that is more sensitive and more accurate. So on this chart over here, you can see this shows you the 10-year Treasury yield minus the 3-month Treasury yield. So in other words, if the 10-year minus the 3-year, if it is below 0, that means that the yield curve is inverted. If it's above 0, it is uninverted. So many people think that when it gets inverted, then a recession will occur, right? Well, not really true. It's when the yield curve inverts and then uninverts, then a recession follows. So let's take a look at this chart and you see what I'm talking about. So over here, you can see this blue line goes below the 0 line, which means that the yield curve has inverted, which means the 3-month Treasury yield is above the 10-year Treasury yield, right? And then what happens after it goes below 0? It goes above 0 over here. So this is called uninversion. So when it goes back above 0, ta-da, recession happens, which is in gray. So this gray period would be the recession. Now, then the next time, same thing. So yield curve inverts over here, and then it uninverts in January 2001, and then boom, the recession comes, which is in gray. And then over here, same thing. Treasury yield curve inverts over here, and then uninverts, and then recession. Okay, let's look at the last one, which was the COVID crash. So again, yield curve inverts, uninverts, and then we had a recession, a very, very short recession back in 2020. So where are we right now? So right now you can see that, yeah, the yield curve is inverted, and it's extremely inverted. It's the most inverted over the last 30, 40 years. So that's what's freaking people out. But again, has it uninverted yet? Not yet. So when this blue line gets back above that zero line, when it uninverts, then yeah, maybe a recession may follow, but we're not there yet. So what if we get an uninversion signal in the next few months? What should we do? Should we like sell all our stocks and get off the markets because the recession is coming? Well, let's take a look at the last 1, 2, 3, 4 occurrences, and let's see what we can learn from there, and whether we can use this to predict when to get off the markets and get back into the markets, right? So let's begin with the first one, which is August 1989, when the yield curve uninverted, right? Let's take a look at that. Okay, so there we are. So over here, you can see this is the S&P 500, and right here, we had the yield curve uninvert over here, all right? So once it uninverted, when did the so-called market start going down into a bear market? The market started going down, was it immediately? No, it went down 11 months later, right? So 11 months later, it then went into a bear market. And this bear market was actually a very short bear market. It lasted only 3 months, and then it went up again, okay? And interestingly enough, the bear market started right there in July of the following year. And that was exactly when the recession started as well. So it's pretty interesting because sometimes the bear market starts before the actual recession, and sometimes the bear market and recession starts at the same time, and sometimes the recession comes first and the bear market comes later on. So it's not always the same in every situation, right? And you can see that from the moment of uninversion, the market still went up 7% before getting into that bear market. So some of you may look at this and say, okay, I know what to do. Once the yield curve uninverts, I will sell all my stocks in 11 months, right? Wait 11 months, I sell all my stocks and I get out, and then I buy back again when it gets lower. Now, of course, the problem is that it doesn't always go down 11 months later. Every situation is different, right? And the other problem is that if you had, say, sold everything right there, if you were clairvoyant and you could sell everything at the top, the problem is, how do you know when to buy it back? Because a lot of people say, I want to buy it back lower. And when it goes lower, they think that, no, it's going to go even lower, right? And they say, I'm going to wait. But, you know, but by the time before they buy, it shoots up again. And in the end, they miss out on all this upside because of the need to avoid that short-term bear market. By the way, this bear market went down exactly 20% and reversed back up, okay? So that was the first one. Now, the next one, let's take a look at the next one. This happened here, right? So yield curve went down, re-inverted or uninverted in January of 2001. So this scenario played out a bit differently. So the yield curve uninverted in January of 2001, and the recession started 2 months later in March of 2001. But by that time, the bear market was already in force. In fact, the bear market started in March of the previous year, in 2000. So in other words, by the time the yield curve uninverted, the market was already down 7%. But then again, if you saw this inversion, or uninversion if you will, and you got out of the market, yeah, you could have saved quite a bit of downside from there, where the market went down a further about 30, 40%. And this bear market lasted pretty long, about 31 months. But of course, with all bear markets, they come to an end, and then that led to the next bull market. So again, in this particular instance, you may say, all right, the moment it uninverts, I get out. Yeah, so again, every scenario is different. So, could there be one thing that we do that would work? We'll explore that in a while, but I want to show you all the different scenarios. So you see that everyone is different. The next scenario would be this one. This was the inversion and then uninversion in May of 2007. So let's look at that one. So this one, the yield curve uninverted here, May 2007, and then the bear market started 5 months later in October 07. So from the uninversion to the market going down, it still went up another 4% after that. And then the recession officially began in December of 07, which was 7 months later, right? And then that led to the great financial crisis where the market dropped over 50%, lasted 17 months. But again, every bear market comes to an end, and that would then lead to the next bull market that makes everything back and a whole lot more. Yeah. So again, slightly different scenario. Now let's look at the fourth one, which was just a few years ago. Yield curve inverted, uninverted in October 2019. So how did that one play out? So that one played out again differently. Yield curve uninverted in 2019 October, and then the bear market only started 4.5 months later, right there. So the bear market started in February 2020. The recession started at that same time in February 2020 as well. And then we had a very short and sharp bear market that lasted 1 month, and then again a great bull market recovery. And from the time of uninversion to the recession starting, bear market starting, the market went up another 13%. So in summary, you can see that the yield curve, when uninverted, may anticipate a recession, but it doesn't really tell you when the recession will start or when the bear market will start. So sometimes when it uninverts, the bear market starts 5 months later, sometimes 11 months later, and sometimes it happens even before the uninversion. So as investors, what can you do about it? So there are a few things you can do. Number one, if you're holding on to great companies or the index, you can simply ignore the short-term market cycles. In other words, just hold through the bear and bull markets, because over time, you will do very, very well. Now, some of you may say, but the bear market, if it goes down for 2 years, I want to be able to get out and get back in. Sure, you can do that as well. So one of the things that you could do is that once the yield curve uninverts, it doesn't mean you have to get out straight away. You can watch the trend of the market, right? As long as the market remains on an uptrend, you stay in the market. But once the market reverses into a downtrend, then you could, sell your stock if you want to, or you could hold your stock and then buy a lot of put options to kind of insure your portfolio. So how do we know an uptrend has reversed into a downtrend? How do we confirm the trend reversal? Well, there are many methods. And for those of you who have been following my methods for many, many years, you know that one method I use is called the 50 and 150 moving average crossover technique. Let's take a look at that. So first, let me orientate you. This blue line that you see there, that's a 50 moving average. The green line is the 150 moving average. So when the 50 moving average, the blue line crosses below the green line and they start to slope down, that is a confirmed downtrend. And when the 50 blue line crosses back above the 150 green line and they start to slope up, they both slope up, that's a new uptrend confirmation. So you have to look at the crossover and the slope of the moving average to confirm the change in trend. So let's see how we could have applied it to this scenario back in the 2000s, right? So you can see over here, in blue, right? In blue, we had the uninversion. So this is when the yield curve uninverted, right? And the recession started here. But the bear market actually started earlier. It started over there. So the moment you see the uninversion and that, hey, we're in a bear market because the 50 has really crossed below the 150, it's a confirmed downtrend, then you could have gotten out of the market, sell all your stock or keep your stock and buy lots of put options to insure your stocks. And then let the bear market play out. So in this case, you can see the bear market continued going down, right? It went all the way down, Now, where would you have bought back? You have bought back when the 50 blue line crosses back above the 150 and they both start sloping upwards. That confirms the new bull market, right? So you can see over here, was this a uptrend confirmation? No, this was not, because you can see the 50 moving average, the blue line crossing above the green line. Let me zoom in, right? But the green was still sloping down. As long as one moving average slopes down, it is not a reversal yet. So that was not a uptrend signal. You would have stayed out of the markets, kept your put options, and let it go lower. Now, how about here? Let's look over here. Same thing. You can see the 50 crossing above the 150 over there. but the green is still sloping down. So that was again not an uptrend signal. Now here, over here, that's an uptrend signal. You have got the blue line, 50 crossing above the 150. Blue is sloping up, green is sloping up. So again, once they both slope upwards, that is a bull market confirmation. And then you could have gotten back into the market over here, bought back all your stock, and then ride that bull market all the way up. So yeah, you can use that 150 signal as well. Okay. Now, of course, there's no technical method that is perfect. Every technical method always has its pros and cons. So you have to understand that whatever method you use, you have to understand its limitations. Let's look at the next one over here. Okay, so this was the 07-08 crash, right? Let's see how that one played out over there. Okay, so same thing, we had an uninversion over here, and then the bear market started over there, all right? But you can see the trend was still up, all right? The 50 was still above the 150. The moving averages were still sloping up. But over here, you can see the 50 crossing below the 150, right? And the blue is sloping down, the green is sloping down, and that is a downtrend signal. So you could have sold everything over there, got out of the market, or again, buy lots of put options to hedge your long portfolio, and then that would have been the bear market going all the way down. And then over here, we get that, again, reversal signal, right? The blue crossing above the green, blue sloping up, green sloping up, and that would have triggered that new bull market signal. So you can use this to, again, read the downtrends to the uptrends, the uptrends to the downtrends. In other words, don't just look at the yield curve, confirm it with the trend of the market. And again, you can use these moving averages. Now, again, it works very well. Now, this method works very well when the trends kind of like are very smooth, right? From an uptrend to a downtrend to an uptrend. It's very smooth, it works very well. Now, where it doesn't work well is when the market plunges suddenly, like it goes down rapidly without going down slowly. That happens when it's like a pandemic or something unexpected happens. So for example, if you take a look at the most recent bear market, which we went through a while ago, give me a second, let me just reload this over here. Let's go back to, yeah, this one. This was the COVID crash, if you guys recall, right? Okay. So in 2019, we had that yield curve uninversion, and then we had the bear market, the recession started here, bear market started here, and then we had that plunge. Now, when the market goes down very rapidly, then these moving averages become quite useless, because remember that moving averages are lagging indicators. They take time to cross over, right? So when the market goes down very fast, by the time that 50 crosses below the 150, giving you a downtrend signal, it's too late, because if you wait for that signal and you sell over there, you're selling at the bottom, right? And by the time that 50 crosses back above that 150, giving you an uptrend signal, you buy back there, guess what? It's like, you sell at the bottom and you buy back at the top, and you miss out on all this upside. That's why if you recall, back in 2020, when the market crashed like that, I didn't sell, even though I got that 5150 signal, because you must know when to use a technical signal and when not to use a technical signal. So when the market goes down 90 degrees, we call that a parabolic move, then you ignore the moving averages and you got to use other signals. And if you guys recall, one of the signals I used was an oversold signal that was actually invented by Larry Williams. Credit to him, right? And if you guys recall, it is called the SPX oversold signal, which is this signal I use on weekly candles. All right, and if you guys recall my Coke bottle video where I said, okay, it's like a Coke bottle gonna explode, right? And I bought right at the bottom because I used this SPX weekly oversold signal. Again, credit to Larry Williams that actually created this signal, right? That when you see a sharp 90-degree drop, ignore the moving averages, but look at the Williams percentage R 52 and 13 days, right? When you get both oversold and you get normalized ATR, which is above 80, and all these three align, that's the bottom. We got in right there to ride that bull market up. If you guys recall my video at that time, I talked about all these things, right? So as an investor and trader, you got to be very flexible. There are many methods you can use. You can use moving averages. You can use oversold signals. You have to know when to use what, yeah? But at the end of the day, remember that if you don't want to use any of these signals, you just want to hold on to great companies through the ups and downs, you will also do very, very well. So there are many methods you can use, but the important thing is to not, blindly freak out or sell because of something you read in the media or rumors or predictions of people, right? We make decisions based on facts, based on technical patterns, and we follow our investment and trading plan, and that's how we do very well in the markets, okay? So for now, no need to panic. The yield curve is inverted terribly, but it's not yet uninverted. When it uninverts, I'll create another video and we'll talk about it and we'll look at the trend. Is the trend still up or is the trend reversed down? And what could we do about it? Could we get out of the markets and get back in later on? Do we buy put options? Follow me on my channel and we shall ride through these waves together. Yeah? So in the meantime, have fun. May the markets be with you and I'll see you guys in the next video. Remember to subscribe. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.